Hey everyone, it's Paul with your Bold Profits for this Tuesday. So this week I am going to talk about what I refer to and what we call the rules of the game. And the rules of the game, these are sort of kind of like what it says. In other words, you need some kind of sort of management system if you are trying to make money from the stock markets. In other words, if you just sort of randomly go about it, just sort of like throwing darts, buying and selling without some kind of system around how to manage your money, how to think about how to put your money in, when to take it out. What you end up doing is you end up doing a lot of wrong things at the wrong time. And now you're constantly on this sort of roller coaster ride, both in terms of either gaining, losing money, and also in terms of how it affects you, in terms of how you feel about yourself. So one of the things that I have known from being on Wall Street for a very long time, managing money for big investors, hedge funds, mutual funds, and even for myself, both when I'm trading for myself or investing for myself or speculating for myself, is that the critical factor really in investing is really in terms of how much control you keep of yourself, your how you feel, your emotions, and because that's what ultimately drives the decision. Most people, if you really look at it, when things go wrong, they sell out of fear, and they may even understand and know all the information, yet the feeling of it is so intense that you sell out of fear. So this is why we came up with the rules of the game, and we have this for every single one of our services. And it's something that I talk about pretty much week in, week out for every single service. And it's often the answer when people ask me lots of sort of questions in terms of what should I do about XYZ stock. Eventually, the answer goes to rules of the game. So I want to make a video about the rules of the game, what it is, give a little bit of a reasoning for it. And before I begin, I ask you to subscribe to this channel. And also, if you're interested in joining, whether it be my Profits Unlimited newsletter, which you have to pay for, it goes for like $49 to about $99. There's a link below, profitsunlimited.com. There's also a link below for our free email letter that I and my incredible, amazing colleagues, Amber, Patrick, Tamara, Nick, and Ian, we all write about, and it's sent out, and it's for free. It's got ETF stock picks. We try and keep the single stock picks for the most part, initially at least, for our paid subscribers, and then we sometimes talk about them in the videos as well as in the newsletter. So if you're interested in all of that, check down below. Bold Profits Daily, once again, is the free email letter. ProfitsUnlimited.com, that's our flagship newsletter, goes for $49.99. Okay, so now on to rules of the game. So I actually wrote this down so I would not forget. And I came up with a total of 8, even though officially in our services, there's only like something like 4 or 5. And sometimes some of these are things that I'm constantly refining. So you're actually getting the benefit, in this case, of actually some refinements to it. So the number one rule that I've come up with as a result of my own personal experience, and also having been in this role for now 7, 8 years, which is that many people start in the stock market and sometimes keep going in this way, which is that they pick one stock and they go all in. In other words, they will just put all of their money on one stock. So I understand why people do it, because obviously if you put all your money in, it works out. Let's say the stock goes up 50%, 100%, maybe 200%, 300%. You've doubled your money, you've tripled your money, and it feels great. The thing is the downside of it, which is that if you are wrong, now you end up losing a lot of money. So that's how I came up with rule number 1. Never make an all-in bet on any single stock. And I explained why. In other words, if it goes well, obviously you benefit. If it goes badly, now you've lost a lot of money and you've lost this initial capital. And now it's difficult for you, both in terms of money as well as in terms of your feeling and emotion, to want to make another investment that may turn out better. Which leads to the second rule of the game, which is that we tell our subscribers a general guideline to make a portfolio. And what we say is a minimum, absolute minimum, 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 minimum. And I know I'm repeating myself many, many times. Absolute minimum, absolute floor, rather than being the maximum, absolute minimum of 5 stocks. 5 stocks. And that is a number that is truthfully plucked a little bit out of the air. There is no perfect scientific basis from exactly number of stocks. However, it's a minimum. And what it is intended to do is to give you many chances to win. In this case, 5 chances to win. And that way, if you're wrong about one stock, one of the other 4 can bail you out. If you're wrong about 2 stocks, 3 of those could bail you out. You could even be wrong in some cases about 4 stocks, and even one single stock can bail you out. And a great example of this is our stuff portfolio from last year. Now, that was 4 stocks, I fully admit. Nonetheless, if you invested into stuff last year, Tesla went up by so much, over 1,000%, that the other 3 could have been losers and you would have still been a winner. So that's one of the benefits of having a portfolio rather than just picking one stock. The other thing that this does is that when you are invested in a portfolio, 5 stocks, 6 stocks, 7 stocks, 10 stocks, now you also can be invested into multiple things. Like, for example, we have 2 mini portfolios. Once again, they're both 4 stocks. So I know that that sounds like a violation. Nonetheless, like I said, our mini portfolios are just there to sort of showcase our ideas. And we've got Buzz, which is Bitcoin, Uber, Zillow, and Zoom. And what you'll see is that there's 4 different investments in there. In other words, in addition to being 4 chances to win, it's 4 different ways of winning. So rather than being all in on any single sector or an industry or one part of the stock market, you've got lots of different shots on goal, which now increases the likelihood that you had a shot of making money, and potentially big money, like what happened with Tesla last year. All right, so that's rule number 2. The third one is a mistake that I have made a great deal in my life. And I have to be truthful, I still make this mistake from time to time. Sometimes my own excitement gets over me, and that is to buy in slowly over time. And the reason for that is that if you look at any chart of any stock, any investment, what you will see is this. In other words, a lot of ups and lots of downs, lots of ups, lots of downs. And you can look at it on a 1-day basis, a 1-week basis, a 1-month basis, a 1-year basis, 5-year, 10 years. It is always filled with the same ups and downs. So if you put all of your money all at once, and it happens to be a bad point in time when markets are high, then what you might experience is regret. Then you might feel badly because you put all your money in. Then you might have to wait a little bit longer for yourself to see the stock go into where it's in a gain position, where you start to feel good about yourself. And by buying in slowly over time, you can be opportunistic. You can feel that you can use volatility in your favor. You can actually buy when stocks are selling off. So last week, where we had this big sell-off in stocks where prices went down a great deal, you were able to go in and pick up stocks at lower prices. And by buying in slowly over time, you can target an average price rather than just going in all at once on one day when you feel most confident. And then perhaps the next day or the next week, if prices are low, you feel badly. So that's the second thing, buy in slowly over time. The fourth one sort of is a follow-on from the third one, which is keep cash in your investment account. In other words, in your actual brokerage account. If you have a Robinhood account or E-Trade account or Fidelity or TD Ameritrade or whatever brokerage company, keep cash in there because, as I mentioned earlier, the number one reason why people sell is out of fear. They experience volatility. In other words, a stock that was up 25 or 30%, or a portfolio that was up 15 or 20% suddenly shows only a gain of 5%. And now you start to panic. You start to imagine that it might go into a loss. And that then leads to you wanting to sell. By keeping cash in your account, it accounts for the fact that stocks are volatile. That's just something that is going to happen by nature of the market. Stocks are volatile as buyers and sellers come and interact. Some sellers are willing to take lower prices. Those are recorded at market prices and published and transmitted. That is experienced by you as a decline or as a stock going down or being in a decline position, and that drives fear. So by keeping cash in your account, what happens is that you now have a volatility buffer, an emotional security blanket where even if everything is down, that cash position is just staying the same, staying solid, and it reduces the volatility of your portfolio that you experience and that you feel. And now you can go through periods of volatility and endure through them and wait for the moment when stock prices can rebound. And obviously, as well, if you have cash in your portfolio, the weighting of cash is going to rise as stocks go down. So now you can feel that you can take perhaps a little bit of that cash and actually buy at lower prices. And that is something that actually happened for a lot of our subscribers who we have been telling for a long time, keep cash in your portfolio. So into the March crash, there were a lot of people that bought into Tesla, a lot of people actually bought into 3D Systems, bought into Wayfair and Zillow, a lot of our portfolio companies, and made extraordinary, phenomenal amounts of money. And well done to all of you, because I know what I'm telling you is easy for me to say and hard for you to do. So that's the fourth rule of the game. Now, the fifth one, I have to say, is something that, again, it's something that even now I still do, and I still am constantly trying to work at getting better, which is to focus on the return of your portfolio. Focus on the return of your portfolio rather than going line by line and saying, well, this stock is down 20%, this stock is up 75%, this stock is up 150%. And of course, what sticks in your mind and what matters to you is the stock that is for now showing a loss, showing a decline, and you end up focusing on that. And by changing your focus and focusing on the portfolio return, you are now allow that stock that might just be in a temporary loss position. Perhaps it's a moment in time when there are a lot of sellers that are simply pushing the price down, perhaps for day after day, week after week, because you are able to simply focus on your portfolio, which has winning stocks, and it does have some stocks that right now are in a losing position, allows you to sit in it. And also another aspect of focusing on your portfolio return is that it makes you less likely to do something that really can hurt your returns, which is many people looking at that sometimes also think that the winners need to be capped, and then they sell winners to buy the stocks that are losers. So there's a few different things here that focusing on your portfolio return really makes you do. So this naturally lends a question to how should you weight your portfolio? In other words, let's say you're buying 5 stocks, perhaps you're buying 10 stocks. How do you know how much to put into each? We guide our subscribers to equal weight by dollar amount. And what do I mean by that? In other words, let's say you are buying 5 stocks and you have $2,500. You might put $500 into each. Or let's say you have $5,000 and you're going to buy 5 stocks, put $1,000 into each. Or perhaps you have $10,000 and you're going to put $1,000 into each. That's what we mean by equal weight. Just understand that the higher the weight that you put, higher the dollar amount that you put into any single stock. And if it goes down, the greater the volatility you're going to experience. So based again on my experience and my own from managing money, what I felt is the best way to go about this, which sort of takes some of the emotion out, is to equal weight by dollar amount. And that way you also end up capturing the biggest winners, or even stocks that you may kind of disagree with. Like I've read a lot of emails from people who've written me and said, Paul, I actually disagreed with your investment in Tesla. However, because you said to equal weight, I just sort of swallowed my feeling and I put an equal weighted amount in Tesla, and that ended up being my best performing stock. So by equal weighting out of it, you take your emotions out in terms of allocating the money, and now you put your money into things that, even in some cases where you may disagree with it, nonetheless, that ends up being the stock that went up the most, or that might be the stock that ends up going up the fastest. And by equal weighting, you get your shot at these things that, at least from what I can tell, everybody wants. Everyone wants the stocks that are going to go up a lot, and also that are going to go up very, very fast. So now to the other side, which is that many people want to know, so how should I sell? When should I sell? And the next rule of the game, we'll get to when should I sell. Right now, let me just talk about a little bit how you should sell. And what we tell our readers is to sell on the way up. In other words, sell when you see the stock rising up over time. And no, this may contradict a little bit in terms of what we also guide you to, in other words, keeping winners, things like that. Nonetheless, if you are looking to sell, we would tell you to sell on the way up rather than looking to hit the perfect peak, the perfect top, because it's very unlikely that you are going to do that. And stocks may run for a long period of time. So the second aspect of selling is to never really sell entirely out of a winning stock. Instead, shave a small piece off, a small slice off, and sell on the way up, keeping whatever you can in your portfolio so that it can continue to rise and make you a lot of money. So that's, if you will, the seventh rule of the game: sell on the way up. Now, the last one goes to when should you sell? And once again, this is something that we tell our folks. In other words, we tell our subscribers to use the stock market as a means to an end to make your life better. So when you feel that you have needs in your life, maybe it's to pay off a loan, maybe it is to buy a house or a car or something for pleasure, you want a sports car or a boat or whatever it is that you desire, those are the moments to take some of your money and sell. And that way your timing for selling is dependent on you, rather than making judgments about the market, which you never completely know if you're going to be right or wrong. And the other aspect is that if you're using the stock market as a means to an end to make a better life for yourself, for your family, for your friends, spending things on the things that will make you happy, reduce your stress, or give you and your loved ones peace and pleasure and happiness. To me, these are the ultimate things that the stock market has ultimately delivered for me, and I believe is what is really the primary reason to be an investor and a speculator, again, is to use the stock market to make your life better. So those are my rules of the game. They're a little bit more extended in here than what is in the official document. We'll probably look to revise some of these and refine them some more over time. Nonetheless, that's what we tell our folks when they ask us a lot of questions. Hopefully you were able to find this of some help to you. And if you like the content of this channel, please make sure to give us a thumbs up and tune in for Market Talk with Amber, the Ian Cast with my amazing colleague Ian and I, and of course Amber is pretty amazing too. And also check into profitsunlimited.com if you want stock picks about America 2.0, the fourth industrial revolution, and general guidance like this. We provide this pretty much weekly in our weekly update. And then, as I mentioned, our free e-letter, which is Bold Profits Daily. So that's what I have for you this week. I'll have another one of these for you next week. Until then, this is Paul saying bye.